Okay, welcome everyone to our Wealth Mastermind for the month of November. I am really happy to have Erica Neal here today to talk about infinite banking. And this was something that we have talked about at the KW Wealth Mastermind. And I'm an ambassador for the group. Part of my roles is to go to the mastermind, take the information, implement it, live it, feel it, do all of that stuff, and then come and present it to our market center, the market centers in our region, lots of different offices. And so I first learned about infinite banking, I first heard about it years and years ago, but I didn't really see it in action. At KW Wealth, I started seeing examples, and then I went to Erica and got some more education and got my own account set up. So I am now living it, I'm using it for investing, and I am a true believer that this is a great wealth building strategy. So I am really excited let's give Erica Neal a round of applause today. And I'm gonna pass it off to her, but I used her. She helped me set up my policy, so I wanted to bring in somebody that I knew I could recommend to my peers. So thank you.
Thanks, Emily. Like she said, my name is Erica Neal. I am co-owner, co-founder of Infinity Investment Strategy, so I'll tell you guys a little bit more about us towards the end of the conversation. But like she mentioned, today we're going to be walking through what is known as the infinite banking concept. Now, what I want to emphasize on that is this is the concept, that's a word we really want to hone in on. That's exactly what this is about. This is an idea, this is a discipline, this is a strategy in the way that we look at, use, and view money. And I say that because this is not just saying, hey, we're gonna, buy a life insurance policy, put a whole bunch of money into it, and then, everything just happens magically. No, that's not what this is about. Because I'll tell you guys, if you walk down to your State Farm office and you go get, a permanent life insurance policy from that State Farm person, it is not going to work. I've had many conversations with people that have had negative experiences because they didn't do it as a strategy. They went and talked to somebody and got sold a product. So those are two very different things. So when we're talking about the infinite banking concept, what we're saying is we're taking advantage of the IRS tax code. If you really want to get nerdy with it, it's IRS code 7702. So for all you fellow nerds out there, you can go study that. Infinite banking is saying, hey, instead of taking our money and giving it to a bank where they're going to say, hey, thank you for your money, I'm going to loan it out to someone else and earn more than what I'm paying you, we want to create our own warehouse of wealth, and we're storing cash inside of these policies because of the IRS tax code, and I don't want to say special privileges, but the specifically outlined privileges and benefits that are outlined in the tax code. We're going to take advantage of this asset class, get as much cash into these types of policies as we can, and utilize them for our own benefit, where we get to be the banker instead of being tied to someone else and their rules. So we're going to dive into that strategy today, as well as how it correlates with real estate. So before we talk about, it's been called become your own bank, bank on yourself, be your own banker, right? All this banking terminology gets thrown around. We have to understand, well, why do we want to become a bank so badly, right? And if we look at how banks make money, we can see why we want to become a bank, because they are the most profitable industry in the entire world. More than pharmaceuticals, more than oil and gas, they are raking it in. And I want this to be as interactive as possible, and I do have prizes for people who answer and or ask questions. So who knows how banks actually make money? Go for it. Front row, you get
the difference in the yields of borrowing and lending.
Exactly. So you're exactly right. So the differences in the borrowing and the yields between borrowing and paying out to others. So overall, in one word, if we were to say loaning, what they do is they say, hey, you deposit money with me and I'm your banker. Here's the question. This is the transition period. There's a mind shift that comes with becoming your own banker. We're going to transition from thinking like a consumer to thinking like a banker. So there's a 180-degree flip that happens. My question is, if you deposit money with me and I'm your banker, are your deposits my asset or my liability? Who did you say liability?
Liability.
Yes, liability. Good answer. Deposits are a liability on the bank's balance sheets. It's opposite from what we expect. Now, I will turn your deposit into an asset by loaning it out to Emily. So Emily, when she takes out a loan, that loan on my balance sheet is an asset. So liabilities and assets are different on the balance sheet for a bank than what it is a consumer. The reason that's important is when I'm loaning that money out, I'm going to charge Emily, let's say 5.2%. And I pay you on your deposit, I'm going to trickle down 0.2%. Now, to your point, Where banks are making money is on this spread, but there's a difference between the interest rate spread and the actual IRR. I'm not gonna get too much into the nerd stuff, but the point is, if you deposited $10,000 with me, what that means is I paid you $20, right, 0.2%, and this is very linear, okay? And I profited 520, okay? So most people think, oh, well, the banks make $500, right? That's pretty cool. But what's really happening, and that's not how we calculate true business profit margin. What happened is I invested $20 in you so I could go make $500 on Emily. So if we actually calculate that like an investment, because that's what I did. Imagine getting an investment where you put $20 in and at the end of the year it's worth $520. That's a multiplier of 25. Said another way, that is a 2,500% return on that investment. I'm gonna click over. Maybe I need to be closer to it. 2,500% return on that investment. If you invest $20 and get $520, that's a 2,500% return. That is what banks are profiting on a one transaction. We're not even gonna consider fractional reserve banking and all of that on this one transaction. And this isn't stuff we made up. These are real returns by banks that are being reported. Bank of America Bauer Report reported this in 2016. Now, I'm not trying to throw stones. This is the same industry we bailed out twice, almost 3 times now in the last decade. But that's another story. The point of this is, throughout this entire process, who gets to use, control, and profit the most throughout the entire time? The bank. So who do we want to be in this scenario? We want to become the bank. We want to be in control of our money. So instead of having the bank here, imagine recreating this exact scenario where you're going to have deposits in and loan out, but instead of a bank being in the middle, imagine yourself being smack dab in the middle where you get to be the beneficiary of all of that. Okay, that is the premise of this entire strategy. Now, before we get into the what, we're going to talk a little bit about the why. This is the foundation of infinite banking, and these are what we call the 4 pillars of infinite banking. If you were to take infinite banking and plug it into what you're already doing, and I want to emphasize that, this is not an either or, it's not combative, it's collaborative. This is a yes and, meaning we want you to go out and fund your business. We want you to go out and invest in real estate. I would never say, imagine Emily if I said, hey, give me all your money, don't go invest in real estate, right? Y'all would laugh in my face and run away, as you should. This is saying if you take infinite banking, it's a plug and play, you put it into what you're already doing, what benefits are you going to receive from that? So let's talk about each of these individually. First one is lower taxes. I am not a CPA, I am not your CPA, I'm not an accounting professional, so make sure you obviously consult with your tax professional. But when we're diving into this, we need to understand the differences between the different account types that we have. Self-directed IRAs, again, there's no good or bad tool. They have their own purpose, but there are hurdles that people face whenever they're using IRAs to invest in real estate. The very first thing that we need to talk about is no depreciation deduction. Depreciation is one of the biggest reasons to get into real estate, and you completely forego and lose any and all depreciation benefits when you invest with an IRA. That is a huge kick in the shins. Number 2, deferred taxes. So in my previous life, I was doing traditional retirement planning. I worked in the state pension for state employees, and what I found was more people pay more taxes in retirement than they ever did while they were working, because they fell into this deferral trap. Defer, defer, defer. That is not a strategy, that is a trap. Because think about it, our tax bracket's going down over the next 10, 20, 30 years. No. Am I going to be making less money? Right? Tom Wheelwright, he says, don't retire poor, retire rich, right? I want to be making more money in the future. And then, of course, our money's going to have grown. So deferring means we're paying more taxes in later years. Everything that's pulled out of an IRA when you get to that phase is completely taxable. You're also subject to UBIT. Has anybody heard of UBIT? So unrelated business income tax. Long story short, if you make too much money outside of the IRA, there's an additional penalty or tax that actually reduces the returns you're earning on your real estate investment. IRAs are subject to that. And then, of course, generational taxation. After everything's said and done, you pay taxes on your retirement, you had UBIT taxation. When you pass away, everything left behind gets taxed to the next generation at whatever their rates are. So how do we solve this problem? Well, when we invest using our own IBC account, we're able to really mark off a lot of these hurdles and help overcome that. Number 1, you get to take advantage of any and all depreciation that's available. Whatever asset you invest in, take full cost segregation, bonus depreciation, anything that's available, it is yours. This is treated same as cash. Now, what I'm going to show you guys a little bit later is you have money, right, in your policy that you have put in, and it's growing. It's earning guaranteed growth plus dividends. We're going to dive into that a little bit more. Not only are you able to take out your money, but you're able to take out the growth completely tax-free through the loan strategy that we're going to look at. Okay, so you're using all your money and the growth completely tax-free. You get additional deductions that you can write off today as a straight line deduction. When you're borrowing against your policy, you go in and say, hey, I want to take out this loan for my policy. There is a simple interest rate attached to that loan. Again, we'll dive into that more deeper later. When you take out that loan and you're paying simple interest on that loan, because you're actually using it for your business or real estate, that is an additional business expense that you get to use as a tax deduction today. So you're writing off that interest even though you're earning more inside of the policy. You're also, whenever you get to the point, I don't know about retirement, it's kind of a weird word. I don't know if any of us will ever retire, but we'll get to a point where we want to work a lot less and have cash flow. Everything we're doing today is to build up as many cash flow assets as possible, right? We want to have buildings, we want to have real estate, we want to have all these things in our portfolio generating cash flow. These policies are one more cash flow arrow in your quiver. When you get ready, you call and say, hey, I don't want to put money into my policy, I want it to pay me, and it will spit out a guaranteed tax-free income to you for the rest of your life. There's no UBIT, in fact, there's no IRS tax filing at all. I have several clients that call in October whenever, they're trying to get in before the extension deadline. They're like, hey, what paperwork, what do I need to do for my policy? What paperwork do I need? I'm like, nothing. You don't report it to the IRS. It's completely private. You don't have to report any of that. And then lastly, okay, so we got depreciation benefits up front. You get to write all the interest off. You're using your money tax-free all while you're working. You get a tax-free income when you're retired. And then when you finally graduate from this world and you move on after the fact, everything that is left behind is completely tax-free on the next generation. So this is incredibly important that we know we have tax benefits on the upfront and on the back end, okay? The second one is increased control. So I think all of us, if we admit it, we have some control issues, right? Like none of us want to go clock in from 8 to 5 and be subject to what somebody else says we can do. I want to earn what I feel like I'm worth and I want to use my time the way that I feel is best. So these policies are here to put the control back in your hands. When you go and you access the cash within your policy, you are borrowing or taking the money out on your terms. Now, what does that mean? You can take your money out as a straight withdrawal, which means just give me the cash and I'm done. Or you can take it out as a loan. Yes, I'm going to give you guys some examples of that in a minute. You have the choice. Now, if you take the money out as a loan, what you're saying is, I'm going to pay that back. You are the banker and the borrower. The company is going to set the simple interest rate for the loan, but you dictate how that gets paid back, when that gets paid back, and at what pace. I cannot tell y'all what an absolute godsend this particular feature has been over the recent years. For people who are familiar with real estate investing, it's been slow. Cash flow's been struggling. There have been deals that have not been doing too great. So for people who have loans out, if that deal is not cash flowing, guess what? You don't have to pay back money on that loan. I had a deal that I was in. We went into it, the full first year we knew we were not going to cash flow at all. It was a very heavy value add. So guess what? The first full year, if I'm not getting cash flow from that investment, I did not have to make a single policy loan payment towards my policy. Even though I had the loan out, it didn't matter. I had a developer, he was building out a whole single family neighborhood. I think I told you about this one. It was like 2019. Anyway, he started building out this whole neighborhood. He was planning on it taking about 18 to 24 months or so. It took him over 3 years. COVID hit, all the offices were shut down. He couldn't get permits, he couldn't get materials, couldn't get labor. It took him over 3 years to finish the entire project. The entire time, he kept using money from his policy, did not make a single loan payment the entire time. He got his project finished out, he sold it off all at once, and then boom, dumped it, one big lump sum payment, and then just rinse and repeated the process. So being able to be in control of paying that back is invaluable. You have access to your total cash value. I just mentioned that because some people are familiar with these policies. They're like, oh, well, I thought I couldn't get my cash for like the first 10 years, or there's a vesting period. We don't play games like that. Whatever your cash value is, it is yours. You have full access to it, no surrender charges, no vesting periods. You get to use whatever the cash value is. 100% goes towards your liquidity or your net worth on your personal financial statement. So if you need to go to a lender or you need to show your net worth liquidity to be an accredited investor, you get to use the cash value on your personal financial statement as such. Now, this is truly diversified. Again, I come from the retirement world and everybody likes to talk about stocks and bonds. Here's what's funny about that. Stocks go up, bonds go down. Stocks go down, bonds go up. That's not diversified. That's intercorrelated, folks. So true diversification means when the market goes up, your IBC policy goes up. When the market goes down, guess what? Your IBC policy still goes up. So you're always in that position of buying power. Flexible, so we're going to talk a little bit more about that in a minute, but one of the questions we get on this is, well, how much does this cost? What if I were to ask you guys, how much does a house cost? Right? Like, how much do you want, right? Do you want a dilapidated trailer? Do you want a mansion or anywhere in between? Same thing on these policies. You can structure them to be however you want them to be. what we help you figure out is what's your minimum, what's your maximum, and we help you go anywhere in between. So it's a very wide range. I mean, we've gone from 5 figures to 7 figures and everywhere in between. These policies don't have any minimums and limits on that. And I will tell you something else that we do is we design these so that they can grow with you over time. I have four policies myself. My business partner has 5. So this is something that is designed to build and grow with you as your business grows and builds. And then the last thing is these policies are guaranteed. So I don't know how familiar y'all are with finance, but that word does not get thrown around a lot. You're getting a guaranteed growth on your cash plus dividends. Now, dividends are not guaranteed, but what I can tell you is the companies we use are all A-rated, they're mutually owned, and they've been around since 1850, 1878, whatever. They have paid a dividend every single year since their inception. Every year for over 150 years. And I mean, just think about that, right? That's through the Great Depression, through all the wars, the recession, all of that, 80s dot-com boom. They are the most reliable source of dividends that we've had across the board in the financial world. So, moving on, let's talk about risk. Everybody loves that, right? Now, I love real estate, I love business, it's great, it's wonderful, but there's no such thing as a silver bullet. So we want to build as many barriers of protection as we can against what we call wealth eroding factors. The first one is going to be, like we just talked about, market crashes. Most people are familiar with that. And again, I've seen people who have their liquidity tied to the market. Well, guess what? When does most real estate opportunity tend to present itself? When the market's down. So if my liquidity is tied to the market, I'm going to have to lock in losses to go capitalize on that, right? So these policies, again, they're uncorrelated and they're going up every single year. So you're always in that position of buying power. You're never locking in losses because there are none. The second thing is you are protected against creditors in the IRS. Meaning Texas 100% the cash value, 100% protects the cash value inside of this from being put on hold by creditors or the IRS if you're going through a financial hardship, you have a tax lien, or God forbid you make an accounting mistake, right? And they want to come put holds while you're going through an audit. These policies are protected from that. It's considered to be a part of your estate. We're also protected from predators. Okay, this is a sue happy world, right? We know that. It could be if you have properties, it could be a clumsy tenant, it could be an angry investor. God forbid you go into a syndication and somebody breaks the bad boy rule, right? LLCs are great. All these different barriers are great, but they are able to be broken through. So these are just one more barrier of protection to keep your assets from being seized. It could be something completely non-business related. My daughter is going to be 15. I was just telling her on Christmas Eve, she's going to start driving next year. I will tell you, it absolutely stresses me out to the max. So if she, God forbid, rear ends somebody and their neck hurts a little bit too much, they can sue her, the house, my car, my dog, me, all of it, but they cannot touch the money inside of this policy. It is protected from those lawsuits. I have a really good example of that later on. I'm excited. I just found out about it. And I don't know that I told you this one, but anyway, it's funny. Last one is a run on the banks. We've seen this in small little spurts lately, right? Different runs on banks. We saw SVB and all of that good stuff, even more. But the point is, banks have little to no liquidity. And I don't think we realize how little that really is. March 14th of 2020, major banks, their reserve requirements got lowered to 0%. There is no money at all. FDIC on hand in their reserves. Who wants to guess how much they have in reserves to actually cover what they insure? What percent do you think they have?
10%.
1. They have 1% in the FDIC reserves compared to what they actually insure. There is no money in the banks, folks. Now, do I think there's going to be a widespread bank run? No, that's not the point of this. But these companies that we use specifically are A-rated. In order to get that A+ rating, they have to have a minimum of 100 to 105% of their reserves on hand to cover any and all guarantees that they have. So if every single person went to the company and cashed out their policy, they would have the reserves to be able to do that. 2 of them that we use have over 110%. In fact, I was talking to the CEO. We had a big conference last year before. Anyway, we went to one of the companies and I was asking him like, hey, how do you feel about all this COVID stuff and what's going on? And he said they liquidated over $8 billion in 3 weeks to have on hand because they didn't know what was going to happen with COVID. They had no idea. And so just to know that they had the financial ability to be able to have access to $8 billion within 2 weeks, that was something that was incredibly powerful. And then of course, tighten credit expansion. Banks like to do what they want when they want, right? So we have a guy in North Carolina. I use a lot of COVID examples because it's the most recent, but he has 120 units or so out in North Carolina. He owns it outright. Didn't syndicate it, it's his. Well, COVID hit, rents were struggling, all that stuff was going on. So he needed some cash to funnel into his property. He went to the bank. He had over $1 million in equity in his primary residence. He went to the bank April and May of 2020 to get a HELOC, and the banks told him no. Not a high rate, not a buyout, just a flat out no, wouldn't do it. So do we really own something if we have to ask somebody else permission to use it? So again, these companies, there's no restrictions to the access of your cash. Now let's talk about leverage. That's a real estate investor's favorite word, right? We all love that word. So we want to do a comparison of what does this look like compared to a regular IRA or a basic account like a bank account. Well, let's say that you've saved up $100,000 and you want to take out 70 to go invest or buy a property, okay? When it's all said and done, your money's out working for you, but you're only earning interest on the $30,000 left over. Not good, not bad, this is what it is. On the other hand, if you have become your own banker, if you take out that $70,000, you're going to take it out as a loan. You're borrowing it from your policy. You're going to pay simple interest on that loan, and you're going to go invest in whatever you want. Doesn't matter. Multifamily, single family, Bitcoin. Go to Vegas and put it on black for all we care. Doesn't matter. Use it for whatever you want. But the entire time you've had your money out there working for you and earning, inside of your policy, you're earning compound interest and dividends on the full $100,000 at the same time. So you're doing what Robert Kiyosaki says, and giving $1 multiple jobs. You take your cash flow from that investment, you're putting it back into your policy to pay back that loan, but you're earning compounded interest the entire time your money's been out working for you. Yes?
That, I think I've heard, is that interest set at like 5% or around 5%, or does that usually vary?
You have the option to choose. Yeah, so on your loan, you can choose a fixed or a variable. Most of the time we're gonna do a variable because it's non-recognized, meaning you're still earning. It only changes once a year if it changes at all.
I'll give an example. Mine's variable, and even today, it's still lending at 5.55.
Simple
that's
interest.
Really good.
Yeah.
That's the best. I can't get that from a bank line of credit right now.
Yeah.
Because lenders are like 9% on
Yeah.
investment properties.
Yeah.
So we did a reverse engineering on simple interest versus like a bank amortization schedule. I don't think I have this in here. But if we compared a $100,000 loan at a 5% simple over 5 years, if a bank wanted to have the same amount of interest over that 5-year time span, they would only be able to charge 3.81 or 3.82 on an amortization schedule. So simple interest is much more condensed and easy than what we're seeing on a bank amortization schedule. So the whole idea behind this is, well, we need to understand what Albert Einstein talks about. And it's the most powerful thing. It's what he calls the eighth wonder of the world. He said, those that understand it earn it, those who don't pay it. What's he talking about?
Appreciation, accumulation.
He said it. Compound interest. He's right. Compound interest is the eighth wonder of the world. Now notice he says those who understand it, not those who know about it, not those who listen to a podcast about it. Those who understand it earn it. So what he's saying is, if we were to leave our money undisturbed and continually earning compound interest, it would grow exponentially over time, right? That's not always possible. We have to go into our money, take it out so we can go use it somewhere else. But now we've reset our curve, so we have to start back over until we need it again, and then we need it again, and then we need it again. That's not necessarily a bad thing, but we're disrupting our compound interest curve over and over and over again. So this leads us to it has a gap between what we have versus what we could have had. Now, this gap represents the absolute most expensive and most powerful resource that we all have. What is that? Yes, good answer. This represents time. Time that we've lost, time that our money has lost that we will absolutely never, ever, ever get back. So what infinite banking allows us to do is never disrupt our compound interest curve and still be able to use the money to go out and invest all at the same time. So again, we're doing what Robert Kiyosaki says and giving $1 multiple jobs. And I'm gonna finish up here because I know we're at the top of the hour. Again, coming from the financial industry, I'll tell y'all, it is a my daddy can beat up your daddy world, right? Everybody's better than the other guy. Here's the thing, there's no such thing as a good tool or a bad tool. There are just different tools for different jobs. So if you try to cut a piece of wood in half with a hammer, we can't get mad at the hammer and say, oh, this sucks. No, you're using it wrong. So like I told Emily, I would never tell somebody, hey, put all your money into this policy and then never go do real estate. That wouldn't be doing it right. What we have to understand is, what are we trying to accomplish? And that's gonna tell us what tool we need to use for our money. Now, there's 3 different functions of money: short-term, intermediate term, and long-term. Short-term is pretty self-explanatory. That's gonna be a bank account. So most people, when they're putting money into their bank account, they're looking for some level of safety and some degree of liquidity, right? We can go to the grocery store, get gas, do all those things. The catch with a bank account, though, is that we're not really gonna get any growth out of that type of account. So this is money we need to use within the next year, otherwise we're losing money due to inflation. On the other side, we have our investments. So this is where we're hoping to get growth. We can't guarantee it, but that's what we're hoping for. But all investments carry risk, and investments are not liquid. Once it's in there, it's in there. So this is money that's typically locked up for 5 to 10 years, okay? So here's the savings dilemma. If I want safety and liquidity, I have to sacrifice growth. If I want growth, I have to sacrifice safety and liquidity. So I can put my money into an account where I need to use it within a year, or it's locked up for 5+. There is a huge gap in most people's plan. How do we fill in here what is not being addressed? So again, we have a hammer and saw. Where do we get our screwdriver? We need to be able to accomplish all the things that are not being addressed here. Specifically speaking, there it goes. I want to give myself the ability to earn guaranteed growth. I want my money to be safe. So when I go get it, it is there. So it's safe when I go get it, it's there. It's immediately liquid. I can access it, no taxes, no penalties, no hoops to jump through. Here we go. I'm gonna get tax benefits out of it. And it's completely private and secure, protected from creditors, predators, and the IRS. So again, this is why, if we look at all these characteristics, this is why Warren Buffett actually calls these assets the vault. Think of a vault in your garage or basement. You can put money in when you want, you can take money out when you want. Who knows how much cash you have sitting in your vault at home? Just you, right? It's your money, it's safe, it's secure, and it's private. So the question is, all right, I've got all these things in my pocket, how do I make them work together? You take money out of your bank account and you use it to fund your vault. Your vault's gonna build up cash value. You then use that cash value to go out and invest in whatever you want. The cash flow from those investments, you use to pay your vault loan back. Now, when you're paying back your vault, you are earning more than what you're paying into your policy, okay? Because you have money left over, guess what? That trickles down into your bank account. So all that leftover money goes into your bank account. Now guess what? Now you have too much money into your bank account, so you need to put more money into your vault so you can go do more investing, so you can increase your cash flow, and then. So this repeats and cycles over and over and over, where we have this infinite cash flow loop of money flowing from one asset to the other and back again. We don't want stagnant, moldy money. This is money that's consistently moving, earning, and growing for us, never disrupting that curve. So yes, there is some subliminal messaging here. That is what we do. Infinity Investment Strategies, we help people create these infinite cash flow systems. This isn't something where we just say, hey, here's an IBC policy, then we slap our butt, you're out the door, right? This is where we're gonna teach, we're gonna educate, we're very focused on education. And once your policy's in place, we're there to help you execute and get what needs to be done on the back end. So this is exactly what we do. So I will wrap up here, it's right at 2 o'clock. These are just
You
a couple.
have till 2:30.
Oh, it's until 2:30.
Yeah.
No wonder I was talking so fast. I was like, oh my gosh.
Slow down.
Okay, all right. I'll slow down. I was thinking in my head 1
No.
to 2, 2:30.
No,
Okay.
2:30. You're good.
Well, then I have one other example I'll go through. I want to talk about interest earned versus paid. So in my head, I'm like 2 o'clock. So okay, good. I'm not as bad on time as I thought I was. I was plowing through. So these are a couple of examples that I really wanted to make sure we go through, because one of the biggest comments I get is, you know, Erica, this sounds great. This sounds wonderful. But if it's so awesome, why isn't everybody doing it? My question is, who's your everybody? Who are you talking to? Is it the guy down the street with the subscription to Forbes magazine? Or are we looking at some of the most wealthy, prosperous, financially mature, successful people that have been out there? So top left, does anybody know what that's a picture of? Rockefeller Center, yes. Fun fact, this is the largest privately funded construction project ever built. So Rockefeller wanted to build this monstrosity, and the Great Depression hit. There was no money for anybody. Banks wouldn't lend to anyone, not even J.D. Rockefeller. Like, think about that. Banks weren't even lending to that guy. He still wanted to build it, so he fully funded the entire construction of Rockefeller Center with his cash value life policy. Think about that. It wasn't tied to the market. There was no restrictions to his cash. In the middle of the Great Depression, people are fighting for food and jobs, and this guy's building Rockefeller Center because he had the ability to do so with his policy. Walt Disney, same thing. He had a movie company, but he wanted to start a theme park. So he goes to the bank to get a loan. The little banker told him no. Imagine being the banker that told Walt Disney no to start a theme park, by the way. Like, that guy messed up. But same thing. The first money ever put into the Walt Disney World theme park came from his cash value life insurance policy. Doris Christopher, she was a home ec teacher in the 80s. She had this dream of launching a very strong, very secure cookware company. She wanted to start what's called now Pampered Chef. Well, back in the 80s, she could not get a loan. She was a teacher. She was a single mom at the time. She could not get a loan. So she took $5,000 out of her cash value life insurance policy, started Pampered Chef. By the way, sold it in 2016 to Berkshire Hathaway for like 1.6 billion, right? Like a crazy, crazy amount. So it's a really interesting story. Foster Farms, I love their story because they are the largest chicken producer in the state of California. They have used their policy not only to fund their business and keep that business cash flow and operations going, but they've used it for generational wealth because they're family owned. So same thing as the Rockefellers did, they wrote a book called What Would the Rockefellers Do? I highly recommend it. It's a quick and easy read, but it specifically talks about, one, it talks about teaching your kids the right mentality and all of those things, but it talks about maintaining generational wealth by being tax efficient. So it's an excellent book. But Foster Farms, they've done a really good job with that as well, within their own family wealth dynamic. We see politicians all the time. Donald Trump, Joe Biden, John McCain, the Roosevelts, the Kennedys, all of these guys have used their policies for their own personal investments and to help fund their campaign. I have two schools of thought on this. Number one, if we want our money to remain safe and tax favored, we should probably put it in the same place as the people who write the laws. There's no secret or wonder why these policies have been around. They predate the IRS. They predate a lot of things in our country, and yet they have remained secured, private, and protected. That's not by mistake. Number two, my joke is if Republicans and Democrats can agree on something, it's got to be pretty good, right? There has to be something there if those two are in sync. JCPenney, they're a unique story. We've talked about bunnies and rainbows and all the happy stuff, but JCPenney really faced some struggles during the Great Depression, right? Obviously, they're a retail store. They weren't making any money, any revenue at all. So they actually took out a loan from what we call BOLI-COLI. If you guys get a chance, I highly recommend that you look this up. This stands for bank-owned and corporate-owned life insurance. Yes, banks and corporations own large life insurance policies, and they hold a majority of their cash inside of them. Bank of America and Wells Fargo, 52 and 53 or 53 and 54% respectively of their cash is inside of a BOLI. But if you go talk to their Wells Fargo advisors, they'll tell you to buy a term and invest the difference, right? So if we actually look at what they're doing, they're putting money inside of a BOLI because they understand asset protection and compound interest. JCPenney, they took a loan against their corporate-owned life insurance policy, and they used that to pay every single JCPenney employee throughout the entire Great Depression. They knew they wouldn't have to pay it back until they could leverage out of that tough time. And when they started making money again, then they paid back the loan later on. So there's one more on the asset protection. So O.J. Simpson, this is a new one for me. O.J. Simpson got some really good advice. Again, I don't condemn any of these things. I don't condone any of these things. But he got some really good advice before he got indicted. He was told, hey, you need to put all of your assets, everything you have, you need to sell it and put it inside of a life insurance policy. That's exactly what he did. So when he went to jail and he gets convicted and they start taking all his assets and his money, he didn't have much to show. He really did not have very much at all. He had all of his money inside of a life insurance policy. So he goes to jail, he's sitting there in prison, whatever. He's sitting there doing whatever they do in prison. He gets out, he has all this money inside of a life insurance policy, and now that's why he's sitting there golfing on Mar-a-Lago and living his best life. Because his money's been sitting there all along. Again, I don't say we need to do that, but it's just an interesting strategy to protect yourself on the asset side. So really something to consider. Now, on here, the big question is, well, why do investors choose us? Like Emily said, there's people out there that do infinite banking. There's a lot of great, useful people. But for us specifically, David and I, my business partner David, we have over 33 years combined of traditional financial planning experience. He comes from the stockbroker, derivatives trading world. I did more of the traditional retirement planning. But again, we came from that space, and what we saw was, primarily in the financial industry, they're focused on getting assets under management and chasing rate of return. Those aren't bad things, but what they don't teach you is actually how to make your money create cash flow and work for you. There's a big gap in the financial industry, and that's what we saw there. We met at a boutique independent firm in Fort Worth, and so that's actually where we launched the independent platform. That just means that we are not tied to any one company. We partner with multiple A-rated companies. Often we'll pit them up against one another and say, hey, if you want our client's business, you've got to give us the best rating. So we go back and forth with companies. We pick and choose the best ones for the job, depending on who we're working with. We are authorized infinite banking practitioners. So this authorized practitioner, this is through the Nelson Nash program. If you look at infinitebanking.org, you can see some more resources on that. But this is a program you go through, you take your tests, your modules, right? You go through the whole education platform. You have to take a proctored exam. But after the fact, they actually monitor what David and I do and the policies we put in place. If we were to start putting policies in force that are not conducive to infinite banking, or like these high commission policies that don't have any cash or anything like that, we could actually lose our license. So this is something that is really important. If you're doing infinite banking or looking to do that, I'd love to talk to you. But if it's not me, it definitely needs to be an authorized practitioner. So make sure you look for that. Now, we do specifically work with real estate investors and business owners because that's who we are. We specifically work with you guys because we love the entrepreneurial spirit. We love real estate. We have both done single family, multifamily, that single family new development, self-storage. My business partner's in some RV parks, right? So it's not something where, we don't just talk the talk, we walk the walk. Like, we're in it with our clients, we get it, we've been there. I have some properties right now that I've invested in and they're still not cash flowing. But I use my infinite banking policy to invest, so I'm not stressing over that. So it's something that I can really work with my clients on to help them understand, hey, what's the best way to manage through this particular situation that we're in? And I think the biggest piece of feedback that we've gotten is there's people who understand infinite banking and there's people who understand real estate. But really our niche is that we've helped people understand both of these asset classes and how to make them work together. Because again, this is not an either or, this is a yes and. How do these work together to create one big synergistic system? So I know I have a little bit more time. I don't want to take up too much because I want to make sure we have time for questions. I do want to show, since I have a little bit of time, I do want to show one. Yep, this is the one I want to show. Okay. I want to show one more piece because when we're talking about borrowing against your policy and paying interest on that versus still earning, it's really important to understand there's a difference between money and math. We are taught and we are trained to think mathematically, right? That's very linear. But what we have to understand is money works very, very differently. So this is a hypothetical example. These are not real rates within the policy and all that. I just want to compare apples to apples so we can get that mind shift going. If you have $100,000 that's earning 5% compounded over a five-year time period, we're going to compare that to having a $100,000 loan out where you're paying 5% simple over 5 years. So earning 5 and paying 5 over a 5-year time period, most people look at this and think, oh, well, it should come out to be a wash, right? We'll see. So $100,000, 5% simple over 5 years. The interest that would have accrued over that 5-year time period is $15,487.40. Now, this is where I have people throw their hands up and be like, whoa, wait a minute. This is dumb. I'm paying $15,000 to use my own money. Why didn't I just take the cash? I could have had the cash and paid 0 interest. Well, you're right, but remember, we're recreating what the banks are doing. I paid you 0.2% so I could go earn 5.2 on Emily. So I might be paying $15,000 in interest, but what's been happening the last 5 years that my policy has been earning the same 5%? Well, that $100,000, 5% over 5 years accrued $27,628.16. So spoiler alert, number one, our policies do earn more than 5%. There is a spread on the interest rate, so we can talk more about that later. But I want to point out a couple of things. Number one, this $15,000, remember, you wrote all of that off as a tax deduction. So whatever that means to you on your tax bracket, that's up to you. But this $100,000 that's earning 5%, notice there's nothing in the savings bucket. I would say 99.9% of our clients are consistently putting cash under their policy every single year. So that interest is going to continue to increase as you continually fund the policy. And the last thing I'll mention is we paid 15, we earned 27. That's a nice spread, but that is in addition to whatever rate of return or whatever investment that you're doing or that you're invested in outside of the policy. So this is just the cherry on top of what you're already doing. Same investment, same risk. You're just getting an arbitrage spread on your money while you have it out invested at the same time. So it's really important to understand the difference. I think I'm in a room that you guys get this probably a lot more than a lot of people, but how many people do you think actually understand amortization schedules? Yeah, that's exactly the right answer. Chuckle, right? Just laugh because there's no telling. So my point is, a few years back, when we were getting 3.5 and 2.7% interest rates on 30-year mortgages, this was great. These rates are incredibly low. The interest rate itself is very low. But when we look at the volume of interest, meaning how much interest actually leaves our pocket, the volume of interest, because of the way that banks structure their loans on amortization, is incredibly high. On a 3.5 over 10 years, 58.1% of our money has gone to interest. On a 2.7, 49.8. So even though the rate is very low, the volume of interest is 50 to 60% in the first 10 years. This isn't good or bad, it just is what it is. That's not saying banks are, awful. I have I think I locked in like a 2.72 or something like that. It was great and I love it, but when we really look at what amortization and what banks charge versus what these policies charge, this is exactly what I was mentioning earlier. So don't try to read all those little numbers. I know it's really small, but what we did was we looked at, okay, $100,000 over 5 years. If we have a policy loan, simple interest of 5%, if a bank wanted to have the exact same amount of interest at the end of 5 years on an amortized loan, they would only be able to charge 3.81. Emily, your loan right now, you said like what, 5.5?
Mm-hmm.
Where can you go in any banking world and get a loan for sub 4%? So is it always going to be that way? No, not necessarily, but you get the option to pick and choose. So again, those are just a couple of examples of how we've used it. Again, the arbitrage. Now, what I do try to tell people is, these policies are incredibly powerful. It is important to understand them. We'll move into the questions piece of that. Any takeaways that you have? I do tell people if you have questions or want to look at this for yourself, that's great. We do have to go through an underwriting process. So it is important to make sure you understand how that works. Again, it's not difficult. It's super easy, but it gives you the ability. It's kind of like applying for a home. If you get approved to buy $1 million home, do you have to buy $1 million home? No. In fact, you don't even have to buy a home at all. So again, that's how our process works. But this is very foundational, very introductory. We'll move into questions here in just a second. But just know, as we start to continue the process of education, there's a lot more detail behind, okay, how do we design these policies? How do we get cash in? We know the policy is going to have a cost. How do we overcome that cost and get this cash in and out as quickly as possible? We have some examples of actual investments and cash flow models. We have a multifamily example. We have a single family example. And then, of course, like I mentioned, we can give you more details on what the underwriting will look like. And again, we'll get more and more specific with each person. But again, we can talk more about that later. So I'm going to stop and ask for questions. Yes.
Yeah, hopefully 3 quick ones, because I'm kind of familiar with it. So basically, in your example where you held it for 3 years, there's no real payback period?
No, you get to set your payback period.
Okay. And then I know, like, if you were to die and pass away, they would just deduct that, whatever loan's out. Okay.
Which I'm going to go through an example of that real quick. So I know, so what he's saying is, why are these insurance companies so lax on the payback schedule? That's exactly what's happening. If you have $1 million in death benefit, but you've taken out a $100,000 loan, they are secure, okay? They are secure in that loan. You can go and say, hey, I have $300,000 in cash. I want to cash out. They're going to say, hey, we're sorry to see you go. You have a $100,000 loan out, so here's $200,000 of your money back. They're secure if you leave. They're also secure if you pass away. Because if you have $1 million death benefit, but you have a $100,000 loan out, they will pay back that $100,000 loan. Here, Mr. and Mrs. Beneficiary, we're sorry for your loss. Here's $900,000 tax-free. So that's exactly what they're doing on the loan.
Okay. And then, this is going to be something set up for me later because I'm not there yet, but or can you start at a term policy and then flip it just because of you want to get in, I'm 35, healthy, but still got to keep, my payments. How does that, doesn't work, and then how?
Absolutely.
Does that work?
One of my favorite clients, he's super young, he's out in California, and he did that exact thing. So he was like in his 20s when he started, really young guy, and he said the same thing. I love this, I see the value in it, but I don't have a lot of money right now, but I want to make sure that I lock in my health rating. So he got a little term policy that he was paying 25 or 30 bucks a month for, whatever. Well, when he got ready and he said, hey, I'm ready to start funneling cash into this, what he did was a conversion, meaning he changed his term policy to a whole life policy that would receive cash. And at that point, he didn't have to go through underwriting again. He had locked in his health rating 2 years prior. So he was able to convert and start putting cash into it and more and more and more as he went. So yes, absolutely.
So it doesn't bring anything funded or that you previously funded. It brings forward whatever your health or whatever your...
No, that policy will be new starting forward. So everything you do on the term side is going to be like a regular term. That's just pure cost.
Yeah, it's gone.
Yeah. So that's the motivation to get it done as quickly as possible so you can start building up equity.
So the only benefit was if I started younger, it's based off of that, and I don't have to, if elements come, then I don't have to read.
Unfortunately, and we want everybody to have a long, healthy life, but unfortunately, like in our business, we see it more often that, hey, I want to start this in a couple of years, but things happen, health changes, and some people become uninsurable. So having that term policy just means that you can convert in the future, regardless of what's changed in your health. you're still gonna be approved on whatever health rating you got the years before.
Okay. And the last one, and I just want to verify. So you can, of course, have a policy for each member of your family.
Mm-hmm.
Somebody said you might even be able to get one for your parent somehow, and I'm like, but my mom is 75, has diabetes, blah blah, and they're like, yes, there's still a way. Is that true? Or
It can be, right? So you can get a policy on anybody that you have what's called insurable interest. So as long as you have insurable interest and a reason to take out a policy on that person, you can take it out. So I've seen people get it on their parents if they are maybe in business together or anything like that. Now, if you're wanting to put cash into a policy, I'm not gonna elect a 75-year-old with diabetes to do that. That may not be the most efficient way to go. I've seen the opposite. Maybe I'm the 75-year-old woman with diabetes and I wanna start using this and I want a policy and I wanna put cash into it or whatever. I'm not healthy, but my kids are healthy. My grandkids are healthy. Guess what? I'm taking a policy out on them. I don't wanna take it out on myself. So I don't know, can you do that? Yeah, that might be more of like an estate planning death benefit play, sure. But for the cash flow side, you'd probably see the opposite.
gotcha.
So what's the difference between like what you do versus like the big banks like Northwestern Mutual or one of those?
So I actually have a contract with Northwestern Mutual. So they're one of the companies that we've used. I right now I'm not using Northwestern Mutual to do these policies. They're a great company, very financially strong. Their loan rates are a little bit higher than what I can get with some other companies. And they're also not as infinite banking friendly. They make it a little bit harder to get the cash than what some of my clients would like. But yeah, so we've
So you're
used,
kind of like a broker.
yes, I'm an independent broker.
Versus just being with one company.
Exactly. And I did that before, like when I went in the financial world, I worked for company ABC. And when you get contracted like that, you're stuck on selling product ABC. So I liked the idea of being an independent and being able to go out, shop, and do different things. Like I said, I make companies, go fight one another and, compete. Yes.
So I have a question for you. You said the whole deal is to become the bank and get all the advantages. So at what point do you see people actually doing this? What investment value? Are you talking, you gotta be probably at 100,000, 200,000? Are you talking young at 50,000 or 20,000 and then finding whatever your investment vehicle is that you're gonna push the money over to?
Yes to all. I mean, we've seen it. Like I said, we had a young guy who was starting, he was just doing some wholesaling, doing some flips, and he started with a small term policy. We have other people that are older, and so they're taking large sums of cash and putting it into it immediately and then everywhere in between. So really what our job is to really, when we're working with people individually, figure out, hey, how much cash are you wanting to put in? How much cash are you wanting to get out? And helping you design a policy that you're gonna be comfortable with. But like I said before, the big thing is knowing you need to start where you know you're comfortable, because the way that we design policies is that they can get bigger over time. And what I mean by bigger is there's a premium associated with these policies, right? So the premium, whenever you're paying that, you have the ability to put extra cash over that, just like your mortgage. You can pay over above your mortgage if you want to. It's optional, but that's the extra cash that you can put into that builds up cash value faster. Our job is figuring out how do we get your costs as low as possible so you can get your cash in there and start using it to go invest, but also making sure there's IRS limits, and that's kind of where we talk about the policy design a little bit, but our job is to help you figure out, like, you have a minimum and a maximum. How do we make that as efficient as possible? But you can really go from any funding range.
And I'll give a personal example. So like my minimum that I've said I'm gonna put in every year is 30,000. So, but I can go up to 100,000 a year. So if it's a good year, I can put in 100. And I can probably put in maybe a little bit more than that. But I only have to put in 30. And then for my daughter, it's even less. And so if we have a few minutes left, I'll show Riley's policy and we can kind of just talk through like what I'm thinking about with a 2-year-old, how she'll be able to use her whole life policy when she's 20 and when she's 40 and things like that. So, and then going back to Michael's point, Brett Tanner, who leads KW Wealth, he takes out whole life insurance policies on all of his people who work in his organization. Because his business partners, essentially, because he wants to be protected if something happens to them. And he a lot of them are younger than him as well, so he can get better rates, things like that. So
Absolutely.
I'd
There's
be
a lot of
scared
corporate
working
structures.
there or something like that.
Yeah.
I'm gonna claim my policy here, what happened?
End up on an episode of Forensic Files. But no, there's a lot
The
of
whole
corporate.
building goes
So
down.
pension plans have really done that. Like if we go back pre-ERISA and we look at when people had pension plans, you had these massive companies that you would work for a company for 30 to 40 years, you would retire and they would pay you for 30 to 40 years. Well, how are they able to do that? They did something very similar. People who were in their company, they would buy life insurance policies on them. They would have investments as well. You have investments and insurance. They were using that to pay them out their entire retirement through the pension plan. When they passed away, that person's death benefit would then replenish the pension fund so that they could turn around and use it again. So this is nothing new. This is, I mean, like I said, the Rockefellers have done it. This predates the IRS. People ask like, oh, I've never heard of this before. There's a lot of examples. We just didn't realize what it was when when we saw it out there. It's it's one of those things like do you ever see yellow slug bugs? No, until you start thinking about them and then you're gonna see them everywhere. Kind of the same concept. I'm sure, Emily, you had the same experience. Like once you heard about it and you started asking, it was everywhere. So it's something that it's nothing new, but you just gotta go out there and look for it.
So Emily mentioned something about whole life, like it's termed whole life, but you mentioned something about term. So are there different options within your menu of choices or?
So term isn't gonna build any cash. It's just a death benefit play. Now, here's kind of put the cart before the horse a little bit. We will do a blend of the whole life and the term together. There's a trick to that. Because what it's gonna do is it's gonna increase the amount of cash you can do. Because for example, on her policy, if she didn't have a term policy on there, the amount of cash, instead of being able to put 70 in cash in, she might only be able to put like 30 or 40. We slap a little bitty term right around there. It's ridiculously cheap. Boom. Now the MEC limit increases. Again, I'm kind of throwing some jargon out there. But the point is the cash that you can put in increases. So we do a blend. Now what she's gonna be able to do is in years to come, her business grows, her cash flow grows. And she says, hey, I don't want to just put in 100, maybe I want to put in 150, or I want to grow my minimum from 30 to 50. She's going to be able to convert her term to a new whole life policy, no underwriting, no anything, and it's going to increase what she can put in. So the same policy she's had is going to get bigger and bigger and bigger just by utilizing the term policy we put on there in the very beginning. So we do a blend of both. How and why and the structure is varied per person, but that's why we talk about both. Term doesn't build cash, but it helps us put more in. It's kind of a actuarial thing on the background. Did you have a question?
Yeah, so, I mean, this all sounds great and all, but how and why? Somebody's making money off this. We've all sat down with life insurance salespeople and heard their spill. Somebody's making money, who and how?
Yeah, I make money, for sure.
Sure.
Yeah. So it's gonna be very similar to like the process of buying a house, right? So if you show somebody the house and you help them find what they're looking for, you sell, and you go through the whole process with them. All you're asking is that when they get ready to buy or sell their house, that they do it with you. We're the exact same way. When we go through this, like we don't go through with the expectation of like, oh, you have to buy a policy right now. But we do want to educate, we want to go through the process, we want to kind of get a design. All we ask is that when you do get ready to go through the process of starting your policy, that you go through us, and here's why. When we take we go through your design and we take your design and we say, hey, company A, we want to put this business with you. They're going to reimburse us directly. So what they're doing is they're taking your money, and this sounds morbid, but this is what insurance companies are doing. When you open a policy, somebody else is dying. It's called actuarial science. So they're pooling that risk together. So they're taking your cash in, they're covering all of their costs, all of the, the morbidity costs. They cover the exams, the underwriting, they pay us. They have their administrative fees. So everything that's done is already built into their cost. It doesn't actually get factored into, like you're not gonna have to write a check. We don't do, invoices or by the hour or anything like that. So we get paid as independent brokers when we take your business to the company directly.
Is there a certain age that this doesn't work very well?
You can't get insured after the age of 85.
So that explains Joe Biden's loans. That
Yeah. He has 8. So back when he was the vice president, they released like financial records, and so he actually has 8 whole life policies. Many years ago, I'm sure. Yes, ma'am.
How are you able to get more than one?
Good question. So companies are going to go based off of what's called your economic life value. Again, this sounds morbid, but we're all worth a certain amount, okay? based on your income, your net worth, all of that. So when I started my first policy, I was 25 or so, right? What I was earning, what I was worth at the age of 25 is a lot less than what it is now. So when I got that policy, I got the maximum they would give me. Well, now, here we are. I'm not going to tell you how many years later, but I'm now worth more. So I went and got another policy. And because my economic life value had increased, I was able to get even more. So as your cash flow, your net worth, and all of that increases, you're technically worth more. And, people always ask, like, I don't want to be worth more dead than alive. Neither does the insurance company. They will not do it. We've tried. There's some people that want to do a lot more than what the company's willing to pay them. Company will not do it, because if you're worth more dead than alive, then that's not beneficial for them. So you can't do that.
Is there any type of I know this concept is more based off of, I guess, the cash value that you put in, but is there any ratio, just in general, 10,000 gets you 100,000 policy, or 10%?
As far as what is the cost of the death benefit?
Yeah, how much you have to put in to get you how much
Oh, I see. Okay.
policy?
It's going to depend on the year. So I'm going to use 100,000 because it's an easy number. So for example, if somebody puts in 100,000 in year one, they're going to have access to, I would say probably about 70% of that, depending. Sometimes 70 is probably the good number.
But if they put in 100, is that equivalent to them also getting $1 million?
Oh, that could vary. That's going to vary on age, health,
Okay.
female versus male,
So
all of
there's
that.
not a percentage on.
Mm-hmm. That's part of the underwriting process.
Okay.
So year one, you're going to have access to about 70 of it. Now year two, that person puts in another 100,000. They're going to have access to the same 70 as the year before, but they have a new 90-95 available. Okay. Now the question is, well, where did that 30 go in the first year? Well, that was part of the acquisition cost, just like buying real estate. If I buy a property, do I have equity, 100% equity year one? No. We bought an asset, so that's what happened. We purchased a legacy asset, we purchased this asset, so we're not gonna have 100% equity. You have access to your cash of 70, but the 30 went to actually pay for the policy. Year two, not only does your 70 in cash go to cash, but a large majority of the premium is also going. Like I said, 90-95, same thing. Year three, usually 90-95. Year four, we typically see, if you put in 100, you're gonna have access to the full 100, right? So you're cash in, cash out, usually by year four. Now, year five, at that point it drops down, let's say you only put in the base, you don't do any cash, you only put in the 30,000. If you put in that 30, it grows by, I don't know if you have yours pulled up, but it might grow by 40, maybe 45, right? So at that point, you're not putting any cash in, you're just paying for your policy, but you have so much compound interest and dividends earning, when you put in 30, it grows by 40 or 45. So at that point, what I try to tell people is we can't think of it like a cost. Because if I put 30,000 into something and I get 45 out, how much did it cost me? Right? Yes, ma'am.
So, this may not be a you question, but I have 2 whole life policies. The amount that I pay for the policy, I write off on taxes. If you pay cash above and beyond that, can you write that off as well?
Tread carefully doing that, because there's no free money. If we take the tax benefit up front, we lose the tax benefits on the backside and the death benefit becomes taxable. So if you do that, yeah, you can write it off, but because that cash is going to increase your death benefit too, what happens is on the back end, when you pass away and your death benefits however many, millions of dollars or whatever, at that point, all of it becomes taxable on the back end. So there's no free money. We got to pay taxes up front. This is very similar to like a Roth. We put after-tax dollars in. We're going to lower our tax liability today through depreciation and other, business expenses. And then everything on the back end we take out on a tax-free basis. So yes, but just know what's going to come on the other side. Good question. Anything else?
So let's talk through an example. So let's say you put in 100,000. In the first year, you get 70,000 of that as cash value. So you can use the 70 automatically. And you could go, let's just say you found a good rental property and you can put it as a down payment on a rental property. What we see a lot of people doing in KW Wealth is they've bought this investment property with their whole life, money they've lent from their whole life, at essentially, they're borrowing it at say 5.5%, but their 100,000 still in there making, say 6 to 7%. And then the rents, like the profits from that rental property go back to pay that policy loan off. And so as that gets paid off, they buy more property, and that's when they start needing more policies. So one, they're worth more, but two, like all of a sudden their investments are now funding their whole life policy, and they're not actually putting any of their own money into it anymore. Their investments are funding it. And whether it's that next $100,000 a year, eventually you get to the point where your investments are paying for that money going in.
That's an excellent point, and I'm glad you brought that up, because sometimes when we look at this, we're thinking, oh, well, I've got to come up with this money every year, right? It's not new money. Like we said, we are going to encourage you to take that cash and go invest it to create cash flow. So your cash flow should be paying for your policy loan. It should be paying for your policy. And all the new money that you're going out and earning, that's what you're going to use to go get that next policy. So you're not creating new money for your policy. You're getting recycled dollars that are coming in as cash flow and investment. So I'm really glad you brought that up. That's an excellent point. You want to recycle money, go invest it, right? Like, if you have money just sitting there, is it going to hurt? No, it's going to grow. It's going to be better than what you're getting in a bank account for sure. But the best use of these dollars is to go out and make it work even harder. Yeah, really good point. Any other questions?
Do you have a QR code or contact thing?
I have my cards.
Okay.
Feel free. I have a QR code on one of my presentations, but it's always kind of finicky.
I'm gonna show Riley's whole life policy if that's okay with everyone. If you have a few minutes to.
You just want to
Yeah.
see?
Yeah.
Perfect. I was trying to pull yours up. I don't have it saved. I think it's on mine.
Oh, yeah, no, she wasn't that smart.
I'm just saying, that's
But yes.
There might
Okay.
be a QR code.
So Riley is 2 years old, and I chose this level. So this number right here, I'm putting in $16,000 a year for her. Now, my anticipation is when she's like 20, 25, like she'll be making $16,000 a year, and she'll fund her own policy eventually. What Erica mentioned is like, so this cash value, I can lend $6,000 from this account right now. So I could go and I could lend $6,000 of that money at 5.5%. But if you see, so looking forward, one of the reasons that, okay, one other point Erica made is, let's just jump to year 10. I put in 16, but I'm gonna come over here, I'm right here. This cash value, it starts at 122. I put in 16 and it goes up to 141. So it's going up more, it's going up almost 20, maybe 19,000. So I'm getting kind of free cash value at that point. Another point I want to make is when she's 20 years old, let's look at, oh no, I broke
There
it.
it goes.
There we go. Okay, we're looking at this number, let me highlight it, this number right here. When she's 20 years old, the cash value of this policy will be $300,000. So if she can use it to buy a house. She can use it to start a business. She can use it to pay for her college fund. She doesn't have to go and get student loans. She can borrow money from her whole life policy. I'm not sure why it's doing that. But so this is, I'm trying to set her up for success in the future. And you know, as you scroll down, when she's 40 years old and her, you know, she might have kids by then, who knows? At the age of 40, her cash value will be $883,000. Like that's money where she can, like I said, start a business, make her investments, use this money and invest it. And so one, it'll be kind of a teaching opportunity, but it'll also set her up for success where she will never have to go to a bank to get a loan. She will come to our family bank. This will be her family bank when she gets older.
Now it's on her, but do you control it? So you are the one that says at 20, I will let you, or she has the ability, because it's on her.
She's the owner and the beneficiary and the payer.
Okay, just like a trust.
Yeah,
like a trust.
it's very similar to a trust.
Okay.
Which she brought up a good point, which we hadn't talked about. I just want to say this one thing. So she mentioned college. Just so you guys know, remember, think of the vault door. You can open and close it, protect it. So when you go, if your kids are going to apply for college and they're going through the FAFSA or scholarship applications, they will use anything and everything against you. 529 plans will hurt their chances. IRAs, 401ks, bank accounts. You don't have to disclose a single dollar that's inside of your IBC policy, and it cannot hurt their chances if they're filling out FAFSA or scholarship applications. So you can use it to pay for their college, but I don't fund 529 for my kids. Absolutely not. I put everything we can into their policies because they can use it. It won't hurt their chances. Or if they don't want to go to college and they want to go start a business, they'll have the ability to do so as well.
And then once your dividends start matching what you're paying in, you could even have your dividend pay the amount then.
Oh yeah, your policy can pay for itself whenever you want.
Yeah.
Well, whenever you want. Whenever it gets to the point. Usually it's prior to the dividend being able to do that. Most policies, now I'll tell you, this is kind of the difference, like the mind shift. Kids policies don't take off as fast as an adult policy, believe it or not. It's kind of crazy. Think about a kid. They have a much longer mortality table. So you can't put as much cash into a kid's policy as you can an older person's policy. So think about a 15-year note versus a 30-year note. You're gonna be able to put a lot more cash in because your mortality table is shorter versus a kid. So it's kind of interesting how that happens.
So I know you said that for her daughter, she's the beneficiary, she is the owner, she's all that. So can she take out money on that one, or only the daughter can?
Oh yeah, she can.
Yeah, like I could use the $6,000 cash value today and I could use it to go buy a note or put it towards a private lending or put it towards a rental property.
And then basically you're gonna be paying it back or whatever.
Mhm.
Okay.
Yeah.
So basically, you can take out whatever you've put in it, plus some appreciation, because the numbers look like they're compounding a little bit.
Mhm.
But the death benefit column, that's really got me confused there. So if something were to happen in, let's say, when she's 5 years old, does that say the death benefit is 2.3 million,
Correct.
and you've only put in 3 years of 16,000?
So yeah, here in year 5, it's 2.437. Yeah, so that would be, and I know that sounds morbid, but from like a realistic perspective, like I can't even fathom the loss of a child. Like I can't mentally or emotionally wrap my brain around that. I'm not going to work. I'm not going to do it. So that's something that is, I hate to say it, but that death benefit is something where if something were to happen to your child, maybe not at 5, but even 15, 16, teenage kids, whatever, that's something that parents use as a income replacement, just like you would a spouse or anything like that. But yeah, now that's the thing. A young person, their death benefit is going to be way higher than an older person. But an older person is going to be able to get more cash in with the same amount of death benefit. So it's kind of a teeter-totter effect.
How
That
do you feel-
16,000 a month is based on the years based on the death benefit, like for what you put in basically.
Yeah, the death benefit's going to be based on age, health, and whatever you're
Is
putting
there a
into it.
minimum you can do with like kids for that?
I think the minimum death benefit is like $25,000.
Or the minimum annual premium. Which one are you asking?
Either or really, I guess is kind of.
Depends on the kid. So like, so I have a 9-year-old and a 15-year-old that we started their policies, oh my gosh, a long, long time ago. And we've gotten them a couple, Kylie, my older one, has 2 now. But originally, I think I started hers at like $2,400 a year a long time ago. And now they each have about $10,000 a year that's going into their policies.
So she basically asked me what I was comfortable putting in per year, and I said, between 10 to 20,000 a year for Riley, and so we kind of landed on 16. So that was completely my call. It could have been 2,400 a month or 2,400 a year. Like it's whatever you're comfortable with.
And I feel like they ask you quite often if you want to add to your amount or get a new
I think it's me. I'm so sorry.
I think it's my computer.
Okay.
Yeah, I think it's
Static
connection.
energy problem.
The connector itself.
Yeah, it's probably just because it's hanging.
Is that something I guess do you recommend always, like you said, you have 4 now, do you recommend adding on? when
Once you
can?
max out your policy, absolutely, right? And the kids policy is a little bit more difficult to see, but even on an adult policy,
That's what.
yeah, we can. I have this one that was just saved. I don't need internet for. It's nobody here knows him, so you don't have to worry about it.
That's my next door neighbor.
Close out. Here we go. Close out of this. Close out of that. Is it a dual screen? Yeah, it is a dual screen. That's why it's doing that. So, for example, on his, he's doing a minimum of 15 with a maximum of 50. So, after this year 5, he cannot put any more cash in. He has maxed his out completely. Even if he wanted to, couldn't put any more in because he's maxed out the MEG limit. So for his, let's say for example, in year 6, if he puts in 15, his cash value goes from 223 to 246. So he puts in 15 and gets 23. But he calls and he says, hey Erica, I've been putting 50 into this thing. Now I can only put in 15. My portfolio's grown. I need to make this thing bigger. So that's where we're gonna convert the term and say, okay, maybe we need to make his 15, maybe we need to make it 25, right? Or once, and I'll tell you, the reason I have multiple policies is my first one, I maxed out the term. I converted everything. I got all the cash that I could do into it. I could not put another dollar into this thing if I wanted to. But I have additional cash flow, so I started another policy. Same thing with my husband, because I got to the point where I'm like, okay, I'm putting in my cash, but I can't fit any more in. I have additional cash left over. So if you have cash sitting on the sidelines that can't fit into a policy and you're using it and you understand it, absolutely, I would put as much as you can into it. But that's why we have that term, rider blend, because again, if you're putting in 15 and it's growing by 23, well, maybe I want to make that 15, 20. Maybe I want to make that 15, 25 or 30 or whatever it is, and you'll have the ability to do that. So again, I know we're kind of putting the cart a little bit before the horse, but that just kind of helps to begin to outline, like, why are we designing it that way? And you can see, like, obviously, like I said, it takes off a little bit faster than what we see in the kids' policies, but yeah.
So I've got a question for you on that chart. In year 4, you went from 50 to 15,
Mm-hmm.
and the cash value was 300,000. Can you make an election at that point, or just say, well, I don't want to pay premiums anymore, just take it out of the cash value?
Yes. And you can do that. Yeah, you can. I think on his, we ran it, and it's completely paid for. It can pay for itself effective year 6. And so it could pay for itself forever. He never puts another dollar into it at year 6. Now, let's say, for example, year 5, or let's say year 6, because we're on that. He has $223,000 in there, and he's like, Erica, this is the worst year I've ever had, right? Like, it's COVID 2029 or whatever, okay? It's awful. I have no money. I can't even pay for my premium at all. He can use the cash in his policy to pay for his premium for a year or 2 years, whatever. And then when things, just like JCPenney's did, once things start to recover, he can go back and he can start to put money into his policy again and get started and start, again, not losing compound interest all along the way, but leverage through that tough time and get back into paying his premiums when he gets ready. But again, the point would be, like Emily said, we want to have cash flow from investments that start to pay for this more and more and more. But yeah, you can use that cash value for whatever you want. I used it, so the house that my husband and I now have, when we bought it years ago, we used the cash in my policy to put a down payment on a house. And yes, lenders recognize it. They know where it comes from, don't worry. But my business partner used it to buy his daughter a car, to replace windows. I've used it for multifamily investing, hard money, right? All kinds of things, new development, stuff like that. So you can use it for whatever you want. It's your money, you're the banker. We want to be a good banker and a good borrower. Nelson Nash uses the example of, if you want a grocery store, don't steal your own peas from the grocery store. Don't do that, right? We want to be good bankers and good borrowers, but this just kind of outlines what you can do with your cash as opposed to just leaving it in a bank account. So, really good questions. I have one more booklet I didn't give out. Somebody asked. You asked really good questions, I'll give it to you. But I did give everybody my card, so I have phone number, email, all that good stuff on there. Feel free to shoot me a text. I'm a big texter, or email, and we can schedule a time to go through a little bit more in detail. Hopefully provide some more answers if you guys have more questions.
All right.
Thank you so much.
Thank y'all.
And thank you for staying over. I know this is an advanced topic.